Welcome back, everyone. This is another Lunch and Learn webinar series here at Zacks Professional Services. My name is Mayur Thaker. I am an equity strategist and co-portfolio manager here at Zacks Professional Services. And today we've got a lot to talk about, so let's get right into it. My title of this presentation is along the same lines as what I've been doing now for the past almost 12 months. In fact, it's been just about 12 months where I have been calling for a slowing economy and recession since September of 2022. So we're now a year into that, and we still have not yet gotten the official marking of recession. But I continue to believe that all of the leading indicators of economic growth, as well as S&P 500 earnings, are pointing to continued pressure, continued contraction. And this now includes a new force that is, coming into play now, especially, which are long bond yields. So let's take a look exactly at what's going on with all of this in a very important update here. Today is September 21st, 2023. And here is a summary of the bear case that I've been building and following each and every one of these indicators over the course of the last year. And each of these items have remained in contraction or have gotten worse as the year has progressed into today, September 21st. And so as long as these indicators, which lead economic growth and earnings in advance, remain under pressure, I continue to believe that economic growth as well as corporate earnings are going to remain under pressure. We see that U.S. manufacturing continues to be in recession. Every single manufacturing gauge out there, the Chicago PMI, the ISM Manufacturing, the Philly Fed Index, the New York Empire State Index, they've all been in contraction now for 10 to 12 consecutive months. So, we can continue to ignore this at our own risk because the longer it remains in contraction, the greater the probability that this is going to now begin to show up in the form of lowered earnings expectations for the S&P 500. We also see that backlog, which is a function of both production and consumption, is in deep contraction and remains so. As the ISM new orders, continues to remain at historic lows. The ISM new orders index is a proxy for industrial demand, and that has been in contraction now for the better part of the last year, 12 consecutive months. This to me implies that production will begin to slow. It's going to trigger layoffs in the manufacturing sector. This also implies that S&P revenue and earnings will remain under pressure into the second half of this year and most likely will bleed into 2024 as well. So again, the longer these gauges remain in contraction, the higher the probability that it starts to weigh on earnings expectations for next year. And right now, analysts are still very bullish for next year. But based on the direction of these indicators and the direction of all of these other factors that we're going to talk about here today, I believe that earnings are vastly overstated for next year. We'll see exactly why that is. We also see a decreasing rate of change in cyclical job gains. So, as we know, the headline, non-farm payrolls number have been very impressive this year. But, the majority of those those new jobs created are from non-cyclical sectors, meaning they're from government, they're from healthcare, or they're from education. So if you remove those non-cyclical sectors and look at the true cyclical sectors, which are private sector cyclicals, those job gains are now negative year over year. And so this implies a tightening labor market building beneath the surface. It doesn't yet show it if you look at just the headline numbers, but if you look at the cyclical component of job gains, these job gains or losses lead the headline number by an average of 6 to 12 months. So that means that now that this has gone negative now for 3 consecutive months, I believe that inevitably the headline non-farm payroll number will start to show contraction at some point over the next 6 months. So we're still ahead in the employment picture, but this is going to come under pressure, and that's because we see the leading component of job gains already in contraction. Other indicators that we're entering recession is that the yield curve remains inverted. That's the 10-year yield minus the 2-year yield. That's been in inversion now for the better part of the last year. And now we're starting to see the early innings of rapid re-steepening. The yield curve hit a low of 108 basis points in the minus. Now we're at minus 65 basis points. So still in the early innings of re-steepening, but that could be the signal that things are about to get rocky. It's typically it's not when there's inversion, but it's when we go from inversion to re-steepening. That's when something becomes imminent in the financial markets, and that's what we're starting to see here, especially this past week. But let's keep an eye on that. It's still, in the early innings, but if this continues and we continue to see rapid re-steepening of this yield curve, the 10-year yield minus the 2-year yield, something could be beginning in terms of increased market volatility and, someone coming under pressure. So let's keep an eye on that one. Retail sales, nominal retail sales are still positive, but if you look at real retail sales, which adjusts it for inflation, it's down minus 1.2% year over year in August as of the latest reading. And it's now been in decline for 7 consecutive months. And I believe it's actually 9 months out of the last 10 months. So 7 consecutive months of year-over-year declines and 9 months of year-over-year declines out of the last 10 months. So again, the longer this remains under pressure, the greater the probability is that we are slipping deeper and deeper into recession. Cyclical GDP is also already in recession. So this is the components of GDP, the sort of the subcomponents of aggregate GDP that are truly cyclical. So this is the sum total of residential fixed investment, durable goods consumption, business equipment investment. If you look at just those components of GDP, that's already down year over year, minus 0.8%. This is in contrast to the aggregate GDP number, which is deeply in the black. But again, cyclical GDP is a leading indicator of aggregate GDP. You can't have sustainable positive aggregate GDP without positive cyclical GDP. And right now, that number has been in contraction. The same thing goes with real gross domestic income. So that's GDI, which doesn't get nearly as much headlines. But this is statistically equivalent to GDP. But real GDI has been negative now for 3 consecutive quarters, which defies what we're seeing in real GDP readings. So this discrepancy cannot persist. And I personally am of the opinion that because GDP is not being confirmed by GDI, I believe we're going to start to see increasing number of negative revisions to economic data across the board. And we're already starting to see that, by the way, in the job numbers. And we're going to see a slide on that. But every single job report this year, every single month, has been revised lower to the tune of 16% year to date. That's a substantial negative revision. And I believe that it has something to do with the fact that GDP is not being confirmed by GDI. Also, Conference Board's leading economic index. This is an index of, I believe, about a dozen or so leading economic indicators. And that's been in contraction for 16 consecutive months. We just got an update this morning. And again, this was the 16th consecutive month of contraction. Every single time this has happened, we have inevitably slipped into recession. Meanwhile, banks are still under tremendous pressure. especially regional banks. It's been a bloodbath, and estimates continue to be marked down. They are trying to put out a number of fires simultaneously. They are seeing massive depositor withdrawals. They're seeing rising loan loss provisions. They're also seeing significant pressure on the commercial real estate sector. Those prices are rolling over, as well as default rates are rising. Delinquency rates on credit cards are increasing at a rate that is consistent with recession. So this compounds the ongoing issue that they've always been dealing with, which are large unrealized losses on their held to maturity Treasury securities. And Treasuries are once again getting hit this past week. Especially, it got especially worse over the past couple of days, and especially today. And so, banks are going to see continued pressure on their asset portfolio of treasuries and other, debt instruments that they're holding. Even if they're holding them to maturity, they are seeing escalating unrealized losses on them. And so this is why, if you aggregate all these together, earnings expectations have been deeply bearish for regional banks. All of this points to tightening credit availability, which then leads to that vicious cycle of then reduced earnings expectations for the S&P. So this is all leading to new lows in EPS estimate revisions. And then here's the kicker. Unlike past market environments, the Fed is not supportive of stocks or bonds right now. We have to understand this, and we have to internalize this. Jay Powell has been very consistent, and I give him a lot of credit for being consistent and clear over the past year and a half now, ever since this tightening cycle began. Jay Powell has been very clear that their number one objective by far is to get inflation down. And because we're still, very, very fully employed, because unemployment is still very low, Jay Powell is willing, and he hasn't stated this explicitly, but he is willing, I believe, to see a rise in unemployment if it means that he can get inflation back under control. So right now, the Fed is not supportive of stocks or bonds right now. They are selling Treasury securities. They're not buying. And they do not mind the stock market getting hit. Again, he hasn't stated this explicitly, but I believe that the implication of what he's saying lends support to that view, that right now the Fed does not mind a bear market in stocks, nor do they mind a rise in interest rates, because the economy is fully employed still at very low levels of unemployment, and because stocks are very strong right now. Financial conditions are very, very loose with regards to equity valuations. And so the Fed right now wants to get inflation under control and are willing to see other parts of the economy crack a little bit in order to achieve that objective. So, I believe that the market is at risk right now and is vulnerable to a sizable earnings contraction. And here's the thing, the market is not pricing that in. So that's the ultimate kicker. The market still believes, at least the analyst community still believes, that we're going to see 12% earnings growth next year. And I believe that that's going to come down substantially. Here we see the chart of real yields, the 10-year real yield. So this is the nominal yield minus the 10-year inflation expectations. And this is now well above 2%. This chart actually ends as of August 31st, so it's a monthly chart. But if you go to today, that chart, if you can envision it, is now well above 2%. So this is the highest level that we have seen in almost 20 years, going back to 2006. This is a very, very substantial change in the interest rate regime. When we see cost of capital rise this rapidly and to this extent, this will inevitably put significant pressure on S&P earnings. We have never been through another period in time where we see a substantial rise in the cost of capital without seeing something break under pressure. And that's what we saw last time in 2008. And I don't think it'll be that bad this time around, but I do think that something is going to break under pressure. Or it could be multiple smaller things that break under pressure. That could also be the outcome of this. But a substantial rise in the cost of capital is going to inevitably put a significant headwind on S&P earnings. Now, there are three primary drivers of why we're seeing higher yields despite slowing growth. One is that we have a significant amount of U.S. Treasury issuance over the next year. So some 30% of all government debt outstanding is actually set to mature in the coming 6 to 12 months, which is pretty much the highest proportion that we have seen again in 20 years. So we've never seen this high of a concentration of U.S. government debt maturing all at once over the next year. So, and it's been quite a while since that's happened. Now, number two, if you take that in isolation, it's not that bad. But combined with number two, it starts to get worse, which is that the government is in a deep fiscal deficit, and it's getting deeper as the U.S. Treasury must refi all of this debt that's coming due over the next year at now substantially higher borrowing costs. Because these are long-term bonds that they issued back in 2013 and before, when rates were much lower. And now they're going to have to sell and refi. And now they're going to have to refi because they don't have the money to actually pay off this debt, right? Obviously, we're in a massive fiscal deficit, which means that we're already in an annual shortfall. Spending, still comfortably exceeds revenue for the government. And therefore, they have to pay off this maturing debt with new debt being issued. So this ends up creating a debt spiral of deeper deficits due to borrowing at increasing interest rates. So interest expense is set to skyrocket. It's already hit $1 trillion. So it's quickly becoming among the top line items of federal spending in any given year. And it's about to get much worse as they have to refi a huge portion of that debt, 30%, at rates that are, 300, 400 basis points higher than the previous debt that's now maturing. And number three is what makes it even worse, which is the Fed is remaining steadfast at keeping rates higher for longer. They're now forecasting only 1 or 2 cuts next year, which is down by half from market expectations just 3 months ago when they were expecting 4 rate cuts next year. Now they're only expecting 1 to 2. So this is now starting to be internalized by the market that we're not about to get a very quick and easy rate cut. They're not going to declare mission accomplished, very soon. We're going to see higher rates for longer. And now the long end of the curve is starting to price in that fact and the fact that, the Fed is not buying long-term bonds. They are continuing to sell their Treasury portfolio. And so now the long bond yields are starting to function in a way that they haven't done in quite a long time. So we have true price discovery now in the bond market amid escalating government deficits and no support from the Fed. So now, even if inflation expectations continue to come down, it's possible that nominal yields continue to rise because of increasing credit risk this time around. Not just inflation risk, but also credit risk. Not to say that, we expect the government to default. I don't think they will do that. But at the margin, things are getting worse. And therefore, the bond market is now pricing that in accordingly. So instead of having just 4.5% borrowing costs for the government, which is where the 10-year yield is at today, that could get to 5 to 5.5%, and it's not that bad. It's not the end of the world if we get, Treasury yields at 5.5%, but that means that we're in for continued rising costs of capital, which puts significant pressure on not just the Treasury in terms of, the size and scope of the deficit, but also, because bonds get hit, that increases the borrowing costs for all companies across the board, especially the companies that, are currently running losses on their P&L, which still numbers in the hundreds of companies out there. So again, the aggregate effect is rising costs of capital, which inevitably hits S&P earnings. Now, the market's pricing in an earnings trough. If you look at this, this is an overlay of the S&P 500 with forward rolling earnings estimate, going, out. And so you can see that, the market, priced in, this earnings contraction. And now that we see that, expectations are rising again, the market has risen again. So the expectation is that the trough in earnings are in. However, analysts are still expecting 12% earnings growth next year, but I believe that because of all of these factors, rising costs of capital, declining manufacturing activity, declining aggregate demand, credit under contraction, and all these other factors, these are all leading indicators of earnings. And that suggests that these expectations of next year are still vastly overstated. So I believe that fiscal year 2024 estimates will be marked down significantly as the real cost of capital rises. We are going to see an era over the next couple of months to 1 year. We're going to see rising bankruptcies. We're going to see rising delinquencies on credit cards. We're going to see rising default rates on debt. And ultimately, we're going to see contraction in aggregate earnings for the S&P 500. Even for companies that are pristine. Remember, this is all a cause-effect relationship. So, when you have, small companies going bankrupt, at the margin, that's a net negative for the economy during that time period because at the margin, that leads to demand destruction. And, one thing leads to another. The economy is interconnected. So even though Silicon Valley went under, that's going to have a Silicon Valley bank, I should say, went under. That's going to have a ripple effect on the rest of the regional banking sector, which then has a ripple effect on the aggregate economy, even if you have companies that don't directly have exposure to those problem companies. So again, I believe that these earnings that we're seeing here are going to be marked down. So here's Chicago PMI overlaid with S&P earnings. Chicago PMI remains at recessionary levels. Now, we do see a little bit of a bounce back here, but remember, this is a mean reverting index, so anything below 50 means that it remains under contraction. So even though we're off the lows here, the longer we remain in contraction, the greater the probability that these earnings are going to continue to come down. Again, as I mentioned, real GDI. This has now posted 3 consecutive negative year-over-year quarters. This only occurs during recession. So although we're seeing very robust GDP growth, that's not being confirmed by real GDI growth. So we're still negative on that. Now, GDP plus, which is another measure of GDP by the Philadelphia Fed, it bounced back in Q2, but look at the difference between real GDP, which is in blue, and GDP plus, which is an adjusted measure. They believe that this is actually a better measure of true economic output because it takes a look at GDP from a different angle. And this number is substantially lower than what we typically see from real GDP. So the alternative measure, which the Philly Fed believes is a better gauge of economic activity, is doing much worse. Although it is still positive, I will say that. It's still positive, it's still above zero, but the rate of change, as you can see, is trending downwards, and it's still significantly disconnected from what we see on the aggregate GDP figures. So because GDP plus is substantially lower than aggregate GDP, and because real GDI is much lower and in contraction versus real GDP, I continue to believe that we're going to see negative revisions to the real GDP figures that we're getting. Here we can see a ratio of real GDI to GDP, and you can see that that's fallen, well into contraction at the lowest level since 2008. This suggests that we are going to see significant negative revisions across all economic data, including unemployment. or I should say employment data. The Philly Fed Manufacturing Index, this is at recessionary levels. Anytime it's fallen below minus 25, that's correctly forecasted each of the last 8 recessions. And we did get there earlier this year. It's bounced back, but it's still in contraction as of this morning, which we just got a reading of minus 13.5. So again, we are in contraction and within a stone's throw of recessionary levels. ISM manufacturing similarly in recessionary territory. This has been in contraction now for 10 consecutive months. So again, it's not just the fact that we're, in contraction, but it's also the duration of time that we spend in contraction. And 10 consecutive months is a substantial amount of time to be there. Again, regional economic activity. So this is a chart of the Empire State Index from New York, but similarly from Chicago and Dallas and Philly, they're all reporting deep contractions. This is a proxy for demand, ISM manufacturing new orders. That's again at recessionary levels. It's a proxy for industrial demand. It remains sluggish, still in contraction for quite a long time. This is leading to the work week at factories across the U.S. getting cut. As you can see, this is the aggregate number of weekly hours within manufacturing. That's been in a slow and steady decline. Typically, we see this negative rate of change only in recessions. So recessions are always a slow buildup of many things. So the backdrop is always, building slowly beneath the surface. But then there's always a trigger that catalyzes it. So one of those triggers could be a rapidly steepening yield curve. So this could be a sign of rapid deterioration, which can lead to someone being caught offside. Some institution out there that was, exposed to the wrong, asset class, perhaps, too much in treasuries, and they have a large and rising mismatch between assets and liabilities. Probably what's happening at many of the regional banks right now. So someone could be caught offsides and it could get to a breaking point, which we saw earlier this year with Silicon Valley Bank and SBNY, First Republic as well. But it could be somebody bigger this time around. It could be a U.S. bank. It could be a Citigroup. It could be a Bank of America, even if they're a globally important systemic bank. GSIB, I should say. Someone out there could be caught offsides, and if that happens, that could be a catalyst. But right now, something that is easily measurable is the yield curve, and right now we're starting to see a steepening of that. It's still very early. As of today, it's minus 65 basis points. That's well off the lows here. But it's still very early. But if we start to see this number get, to minus 40 and minus 30, especially, below, better than minus 30, this could be that we have, a imminent event that is about to happen in the market, which will lead to a spike in volatility. So I'd keep a very close eye on that. This is very serious stuff here, and I don't like how any of this looks. These are, by the way, so these are not things that you typically see in a bull market. If this was a true bull market, we would not be seeing all of these different factors simultaneously confirming each other in recession. The Conference Board Leading Economic Index, we just got an update from them this morning. They've been in decline for 16 consecutive months now. And it's firmly at recessionary levels, led by weakening credit growth and manufacturing new orders, as we saw in the chart before. History has shown that forced inversion breaks things. Now, this chart has actually started to gravitate towards zero, so we're starting to see steepening in this chart right here. This is the Fed funds rate minus the 2-year yield, or I should say the 2-year yield minus the Fed funds rate. This is now basically at zero, going from deep inversion to now zero. So again, when we go from deep inversion to rapid re-steepening and therefore positive, spread, that is typically a trigger that we're about to see a market event of some sort. It's very hard to say exactly where that the epicenter will be, but it's something to be very, very cautious of, especially with where we're at today in terms of market valuations. If we were at a 15 PE, I would say, well, maybe a lot of that could be priced in, but we're not. We're at a 19 to 20 PE. And again, banks continue to face tremendous difficulty. They're seeing an aggregate number of multiple things happening at once. They have large and increasing unrealized losses on their held to maturity securities, especially today, where things started to get even more dicey with long bond yields. We are seeing depositor withdrawals. We're seeing declining commercial real estate prices. We're seeing signs of stress in that sector. We can see increasing default rates. We can start to see increasing credit card delinquency rates. And therefore, together we're starting to see rising loan loss provisions. So if you add all this up, banks have no choice but to tighten credit availability. And that's exactly what we're seeing here. So here's a chart of deposits. $1 trillion have been removed from U.S. banks, right? Because they continue to pay nothing on deposits when money market mutual funds pay 5.25% right now. So why would anyone keep money in a bank when they could earn a risk-free return of 5.25% or better? However, it has been stable since April of 2023. However, I think we're about to see a resumption of this of the downtrend here. So we will see, but let's keep an eye on that. But we can definitely see that compared to last year, banks have to deal with a substantially smaller deposit base. And here we see rising loan loss provisions, well off the lows, and is rising. It did take a little bit of it didn't rise as much in Q2 as I expected, but it did rise by about $100 billion there. So the rate of change in the direction of that indicator is negative. As we see during every recession, this number starts to rise. And I think that's what we're seeing right now as well. The net result is tightening credit availability. This is directly from the Federal Reserve. And we can see that respondents to this survey are, very much confirming that they are tightening lending standards. So again, inevitably, when lending standards get tightened, S&P earnings, inevitably get hit. And we can see every time that this number has reached these levels, we have been in or around a recession. So every single time it got to these levels again, we're at almost 60% here, just a hair under 60%. But every time that happens, we are firmly in recession or, getting close to recession. And that, inevitably puts pressure on S&P earnings. So this is not good for banks. This continues to signal deep cuts to bank earnings forecasts. And we can see here, this is the estimate revision trend for the KRE, Regional Bank ETF. It does not look good. And now analysts are, for the first time, expecting contraction next year for regional banks. They're still expecting on average, this is a market-weighted average, of $2.78 for earnings this year. That's a dramatic decline from about a year ago for 2023 at $3.53. That's a cut of 21% from last year. And now next year, they're expecting $2.71. So that's a decline year over year. And again, it represents a 34% decline from the 2024 estimate of a year ago. So again, this is not what we typically see in a bull market, and yet the market is priced for a bull market. It's priced for a earnings recovery. So regional banks are dealing with multiple fires simultaneously. So I don't actually believe that the banking crisis that began with the Silicon Valley, crisis is yet over. Inflation bounced back in August, but the backlog, right, ISM backlog continues to telegraph a drop overall in both headline CPI as well as core CPI. We're going to see a better relationship, I believe, with core CPI rather than headline CPI. But in general, I still believe that both measures of inflation will continue to come down because although the backlog is off the lows, remember anything below 50 signals contraction. And so it's not just the movement of this index, but it's also the duration of time that we spend in contraction, meaning below 50. So we've now been in contraction for almost, I believe, 12 months now, below 50, and actually more than 12 months. And so because that's been happening, I believe that inflation will continue to remain under pressure and trend towards the Fed's long-term objective of 2%. So again, and here's a direct chart of how the Fed has been acting. They are once again reiterating that they are not supporting the market right now. They are not supporting stocks, and they are not supporting bonds. They continue to put pressure on liquidity, as we see here from M2 money stock. It's negative year over year, basically for the first time ever since M2 was published. So they are, relentless in getting this number down. Because again, this is a part of how we get inflation down. We need to take liquidity out of the economy, and they do this, partially by trimming their the size of their balance sheet by removing treasuries and mortgage-backed securities from their assets. Housing prices remain under pressure. However, I think home prices might actually stabilize here because, ironically, supply could be shrinking faster than demand as rates, as mortgage rates soar. People that, own homes and are locked into low rates, they are less likely to be selling their homes and moving. So that takes a lot of homes off of the market, and therefore supply is definitely shrinking, possibly shrinking faster than demand. That might continue for a while. So although we're seeing a decline in home prices, which is part of what the Fed wants, I think that this number may actually stabilize. Again, another indication that we're in recession or around recession, which is real retail sales are down year over year for the 7th consecutive month. This is not what typically happens in bull markets. Now we are off of a very strong base of plus 50%, almost 45%. But again, that was in response to the depression of COVID. So if you take those, they kind of offset each other. So we're actually getting a little bit of mean reversion. But again, the longer this remains in contraction, the less mean reversion it is and the more true contraction it is. So we're still above trend, but we're getting very close to going below trend now on real retail sales. So again, this is something to keep an eye on. But again, this is not what typically happens in a bull market. Now, unemployment is still low. Okay, so this is what the bulls say is that the labor market is still very strong. Unemployment is still very low. However, and this is very, very important to understand, cyclical job growth has flipped negative year over year. And so what do we mean by this? Cyclical employment levels measure the total labor force working in sectors outside of government, education, and healthcare. So what we do here is we look at the monthly non-farm payrolls report, and we look at the breakdown of the job creation, the job gains by sector. And if you remove government, education, and healthcare, what remains is what we call cyclical job gains, cyclical NFP, right? And so it's important to make this distinction for analytical purposes to understand where the job gains are coming from. Is it coming from the government sector or is it coming from the private sector? So if we look at just the private sector, and by private sector, I mean the headline job gains number minus government, education, and healthcare job gains, because education and healthcare, although they are technically private, they are non-cyclical by nature because they don't go up and down with the business cycle, because everybody needs healthcare and everybody needs education all the time. So they are not sort of useful measures to understand the direction of the economy. So if we remove those, then we get an underlying job figure that more closely represents true cyclical economic job creation. And if we look at that number is now in decline year over year. So this declining cyclical unemployment or employment is a more direct reflection of the job situation in the real world, and it is a leading indicator for aggregate employment. So if the cyclical job gains are negative year over year, then inevitably what happens every time over the past many recessions is the aggregate job gains number does end up flipping negative year over year. So this has already started, and this is now the third month. In August, that was in August, that was the third consecutive month where cyclical job creation went negative year over year. And meanwhile, the BLS has revised lower the headline number every single month so far in 2023 by a total of 16% year to date through August. So this is, again, these are all things that you don't typically see in a bull market. You don't see this size of negative revisions. You don't see cyclical components of GDP as well as of the NFP job numbers in contraction. You don't see real GDI in contraction. You don't see the manufacturing gauges in contraction for over a year consecutively. You don't see a deeply inverted yield curve. You don't see, thereafter, a steepening yield curve. These are all signs that, this is not a typical bull market. And yet stocks are in a bull market. We're still up almost 18% year to date. This takes us to almost a 19 forward PE, as you can see here on the chart. This forward PE is significantly higher than previous 5% interest rate environments. As you can see, going back to 2000s to the mid 2000s, the last time we had interest rates this high, PEs were much, much lower. They were closer to 15, as you can see here. The last time we were at a 5%, Fed funds rate. PEs were much lower, and at the same time, earnings expectations were actually much higher. So this is actually a double whammy. Multiples were lower, and yet back then, we actually had real forward earnings growth expectations. Right now, we have, negative or almost flat, basically flat earnings growth expectations. It's still a little bit positive since the end of this chart. This is as of August 14th. I apologize, I actually forgot to update this chart. This number has moved up a little bit to positive 1% as of today. But again, that's not much growth relative to the multiple that we trade at, relative to the interest rate environment that we're in, relative to all of these other leading indicators showing contraction and flashing recession warnings. So I believe that the market is substantially overvalued. We can see here the free cash flow yield of the S&P is now, at its largest spread versus the 1-year Treasury yield by the widest margin since 2007. So again, I don't believe stocks are a very compelling investment opportunity right now. Here is an excerpt from the ISM, manufacturing, index survey. And again, they are, showing signs that respondents to their surveys are getting concerned about a slowing economy and having sluggish demand. We can see this from several examples from private companies like FedEx. FedEx has been reporting declining shipping volumes. They are citing ongoing demand challenges. They are therefore, cutting back and grounding more aircraft. And that, they're going to see a challenged profit environment through 2024. Maersk, this is the number one global shipping company in the world. And it said in its Q2 report, it basically issued a profit warning for second half of 2023 and into 2024, citing major demand challenges. Survey indicators point to flat growth at best, they say, in Europe and in the US in H2 of 2023 and the start of 2024, with a material risk of recession in both regions. they write. So again, this is a company that one would think that has a pretty strong pulse on global economic production growth and therefore shipping. And they are issuing a warning on volumes. Same thing with American Express. They actually reported strong Q2 numbers, but they declined to raise their guidance for the rest of the year, while also raising their bad debt provisions to $1.2 billion from $400 million 1 year ago. So again, at the margin, the direction of these indicators is moving negatively, and this is going to affect aggregate earnings, I believe. If you look at it from a discounted earnings perspective, I believe that the S&P is overvalued by 20%. If we actually mark down earnings and expect a mild earnings contraction next year, even if we follow that up with a recovery the following year in 2025 and a 7% long-term earnings growth rate, you can see that it's not hard to see that the market is overvalued by almost 20%. And again, part of that is driven by a higher cost of capital as we see rising interest rates here. Again, another way of looking at it is a Shiller PE, and that suggests, forward 5-year returns may be very lackluster from today's levels. So my primary conclusions here is that the direction of leading fundamental indicators, all of these indicators that we talked about here today, including rising costs of capital, the direction of all of these indicators at the margin implies negative pressure to S&P earnings. This means that I believe analysts will mark down both this year and especially next year's earnings forecasts. Right now, they're still expecting a very strong recovery in earnings. I am calling, bluff on that. I think that's going to be marked down quite significantly as we start to get Q3, but especially Q4 earnings this year. And at the same time, markets are priced for an earnings recovery at a forward PE of 19 to 20 times. So this is the kicker, where the direction of earnings are under pressure, but the markets are priced for an earnings recovery. So we are seeing a mispriced market at this time right now, in my view. Again, my opinion, I could be wrong, but I believe that all of these factors together are showing that the direction is down, and yet the markets are priced for a growth period. So if that doesn't happen, then there will be a substantial repricing of equities, and therefore a substantial drawdown. So again, my ideal capital allocation for 2023 and 2024 is to stay, defensive. Stay in 1-year treasuries, which pay you 5.25%. You can buy a money market mutual fund. I would be sure to own only those that own just treasuries and or deposits, directly with the Fed, like the Vanguard Treasury Money Market Fund or the Fidelity Treasury Money Market Fund. And then I would also own earning certain companies, meaning the Zacks earning certain portfolio companies that show the lowest beta as well as low Shiller PE multiples, and also have, both dividend growth and share buybacks. I would be defensively positioned, own companies that are recession resistant and trade at an attractive multiple, and own, very short-term treasuries. That's what I would do. I would position for a low growth environment with a combination of recession-resistant growth, that's the earning certain portfolio, plus income that is coming from 1-year treasuries. I would also add to this, by the way, I would own investment-grade commercial paper, companies that have a pristine balance sheet, like owning Apple bonds that mature relatively soon, under a year. Therefore, it takes out the interest rate risk. Even though those yields are lower, I believe that they're much safer to own, and it's going to be a outperforming asset class in my view. So these are some of the companies that we own in the Zacks earning certain portfolio. Again, pristine, world-class businesses, companies that have been through recessions many times around, companies that are able to withstand those recessions. So these are the types of companies that I would own in the portfolio. But I would pay a little bit more attention to not just the companies in the portfolio, but also specifically hone in on the low beta, low Shiller PE companies that are there. So again, these are the characteristics of the companies that we own in the portfolio. So again, this is exactly where we like to be. Be defensive. I would not be taking substantial risks, especially in technology or other high beta, high duration equities right now. I would wait to see what this the eventuality of all of this is. But for now, I would stay out of the NASDAQ, of the S&P, even out of the Dow, and remain defensive. So hope you found this helpful. If you have any questions, if you are a ZRS client, send us an email at zrs@zacks.com. And if you are an advisor tools client, please send us an email at zat@zacks.com. If you'd like a copy of these slides, again, please send us an email. I'd be more than happy to send that over to you. All right, thanks everyone, and hope you found this helpful. Talk to you next time. Bye.